In Washington, Congress and the Bush administration try to jumpstart the economy. In Chicago, futures prices soar to record or near record levels in corn, wheat, and soybeans. And on Market to Market, two of the nation's top analysts offer their insight on what may lie ahead. Those stories and more next.
Funding for Market to Market is provided by Pioneer Hybrid, because sound information plus consistent yields can help farmers stay on track. The people who bring you Pioneer brand corn hybrids proudly support Market to Market. This is the Friday, February 8th edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mark Pearson. There were signs this week that consumers are becoming more concerned that the economy is slipping into a recession. According to the RBC Cash Index, consumer confidence dropped to its lowest level since the index began in 2002. The gloomy outlook comes despite recent actions by the Federal Reserve designed to bolster the economy. The Fed slashed interest rates twice over the span of just 8 days in January, its most aggressive rate reductions in 2 decades. But other forces are weighing heavily on consumers. U.S. employers cut jobs in January for the first time in more than 4 years, and wage growth also appears to be slowing. All the economic uncertainty isn't enduring politicians to the electorate. According to an Associated Press Ipsos poll, just 29% of the public approves the president's handling of the economy. Overall, Bush's approval rating stands at 30%, while Congress's tally plummeted to just 22%. Facing the distinct prospect of an election year recession, the White House and Congress this week took matters into their own hands.
To build a prosperous future, we must trust people with their own money and empower them to grow our economy.
During his State of the Union speech last month, President Bush verbalized the concern of millions of Americans. The administration called on Congress for some kind of package to stimulate the economy. This week, after several days of wrangling, both legislative bodies came to an agreement. The final outcome was a $168 billion stimulus package designed to boost the nation's lagging economy. Once signed by the president, most taxpayers will receive a cash infusion directly into their wallets. The act will rush rebate checks of $600 to $1,200 to most taxpayers and $300 checks to disabled veterans, the elderly, and other low-income people. President Bush hailed the measure as robust, broad-based, and timely. Bush went on to say the legislation will be effective and help stimulate consumer spending and accelerate needed business investment. The rebates will be based on 2007 tax returns and should begin arriving in May. One sector of the economy needing little economic stimulus these days is agriculture. Bolstered by expansion of the renewable fuels industry and blistering global demand, corn, wheat, and soybean prices all are in record territory. The upward trend continued this week as the Agriculture Department released its monthly supply and demand estimates, and with USDA calling for the lowest U.S. wheat ending stocks in 60 years, prices moved a limit higher. For the week, March wheat gained $1.50 per bushel and flirted with $11, while the nearby corn contract wrapped up a volatile week with a gain of more than 7 cents. USDA reduced both U.S. and global soybean stocks, supporting beans in the teens. For the week, March soybeans moved more than 50 cents higher, while the nearby meal contract went up $18.30 per ton. In the softs, cotton trended higher again this week, with the December contract posting a gain of $2.29. In livestock, the February live cattle contract gained nearly $2. Feeder cattle were down 43 cents, and the February lean hog contract declined to $1.80. In other markets of interest, the euro lost 198 basis points against the dollar. Nearby crude oil prices gained $2.81 per barrel. COMEX gold was up more than $26 per ounce. And the Goldman Sachs Commodity Index gained nearly 25 points to close at 620.20. Here now lend us her insight on these wild markets is one of our regular market analysts, Sue Martin, and a very special guest analyst, Mark Gold, joins us as well. So both of you, welcome to Market. And Mark, good to have you here. Sue, let's talk to you. Let's talk about today's numbers from USDA, particularly as they pertain to wheat. The lowest carry in 60 years. That is a darn tight supply of wheat. The markets have been responding. What's ahead?
Well, basically, the market is responding to a short hedge position in the board and needing to get out, and the market's bidding limit. In the process, we're rationing demand. But at the moment, we haven't finished this off. There was news after the close today that starting Monday, all exchanges on the wheat will go to 60-cent limits. And if they lock limit and don't trade on Monday, they'll go to 90 cents on Tuesday. If they don't trade, they'll go to $1.35 on Wednesday. So this is the type of action you need to see to finish this out and clean up the market. There has been an ability to get rid of positions for the shorts if they did it through spreads, whereby they would be buying the March wheat and selling the May or the July. And in doing so, then they could turn around, and usually they were using the July, they turn around and buy back the short July as soon as they were finished off in the March. I think that the key thing here is that we need to look at this wheat market, and it's far exceeded what most anyone thought it would do. The pasta makers are so intent on needing to have spring wheat to blend, they couldn't get it. And there is wheat in farmers' bins in the Dakotas and in Minnesota. Not majorly, maybe a third of the crop. But I think what's happened is they're not selling, they're sitting on it. And usually that occurs when they they get too optimistic, and then they watch the premiums disappear as the market goes down. And with these expanded limits, what it says is the market can go down faster than it went up, and which usually happens. So when I look at the wheat now, it's also driving the KC wheat because it's the next best protein out there. And of course, then, it drags the soft red right along with it. So I guess I would be telling producers that are in these protein areas, in the KC and in the Minneapolis, and even in the Chicago, use these rallies here and get some stuff marketed.
All right, Mark Gold, as you look at these markets, and again, record territory, unbelievable move in wheat, as Sue alluded to, and part of this is the short positions that have taken place in Chicago, people getting blown out. But for a producer, these prices, this is Disneyland without going to Orlando.
No question about it. When you get historic prices like this, we've all been waiting for beans in the teens for 30 some odd years. Now we not only have beans in the teens, we have wheat in the teens. Yeah. The March Minneapolis wheat, basis the option theoreticals, could trade as high as $20 to $21 before it's all said and done. Nobody in their wildest dreams would envision this. It's all about the protein. It's all about the short positions and the margin calls. I understand there's some of our friends up north in Canada have got some serious problems, and it's causing a ripple effect throughout the whole industry. What's key for the American farmer here is it's giving us an opportunity. This old crop is dragging the new crop up to incredible levels, giving us an opportunity to be looking at pricing $10, $11, $12 new crop wheat out there, and at least, in my opinion, buying a put option to protect the downside. Let's see where we can go on the upside. It may not be over for a while yet, but let's take advantage while it's here.
All right, so definitely get some pricing done, is your opinion on wheat.
Absolutely.
All right, now let's, Sue, you agree with that? Do you want to get some sales made here?
I think so. I think this is an opportunity, and you have a lot of volatility. I think another thing's happening here with the wheat, and the beans will probably get there too, and maybe are starting to. I think we're doing a new price structure in the markets, in the grains. Cattle went through this back from 2003. Once they exceeded the $80 level and went to over $1, now they don't barely hardly come back down to 80 cents. And I think the grains are doing the same thing at this time. Like example, what might be cheap for wheat now might be $7 wheat.
Mm-hmm. All right, so Mark, what about that?
Well, I disagree with that. I think we've heard a lot about this new millennium and this new paradigm in agriculture, and certainly the lows have gotten higher, the highs have gotten higher. But in my opinion, at some point, we're going back to those lows. Now, the lows in wheat, are we going back to $3 wheat? Probably not. Can we go back to $4 and $5 wheat? You bet. What we've seen in every historical spike in markets over the last 100 years is we're going to have overproduction, we're going to have demand backing off, as Sue talked about, and when you have a situation with overproduction and a lack of demand, you ultimately lead to a crisis in the market. What concerns me most is with the input costs as high as they are for cash rents, for fertilizer, for seed, for all the inputs that we have out there, what will happen 9 months from now If we don't have a drought, we overproduce, and we have the lack of demand as the millers go out of business and other people go out of business. Can a farmer afford not to protect these prices? The farmer has to have $3.40, $3.50 corn this year in order to break even. He's got to have $6, $7 wheat. He's got to have $8, $10 beans. And if we go back to the historical lows, even though they may be higher than they've been, we could have a real crisis in agriculture. So we want to protect against that.
Now, let's talk about that on the wheat side. The plantings for wheat was really disappointing, the USDA came out with, because of seed problems, things we've talked about on the show periodically, being able to get the seed for one. Worldwide, it looks like we're starting to pick back up. So maybe we will see that worldwide, the Ukraine, Russia, some of those regions start to pick up. Mark, is that what you're seeing?
Well, Canada, Australia this year, all the places where you would normally see some big wheat crops. Russia, we know the Germans are going to be up about 7%. We were up 1.5 million acres on the hard wheat. But coming into the spring wheat, I know a lot of farmers in Idaho where they rotate the potatoes, fallow, and wheat. Wheat's just a cover crop. $15, $20 wheat is going to make much more than a cover crop. And that's all, a lot of it's irrigated off the Snake River, so they can get 100, 120 bushel wheat up there. High prices will make the American farmer look around, and nobody is better at taking advantage of this than the American farmer, and they will plant and get the job done. And unfortunately, this overproduction will happen around the world, and ultimately it's going to lead to lower prices.
All right, Sue, and following that, I think it follows what you're saying. Would you go out and sell some 2009 wheat?
Well, I think I would on this rally. Here's the problem. You're getting your commercials, your elevators, that are not wanting to partake in that. They're a little leery selling, like, say, a new crop a year out, because they know that that's margin money that's going to be on the hook for a year, along with interest on that money. And so you've got elevators backing away from doing so, even in corn.
All right, Mark, you see the same thing in wheat?
Well, not only in wheat, we're seeing it in corn and soybeans as well, where the elevators don't want to be out on that hook. We've seen the banks now curtailing the commercial activities, the commercials curtailing what the farmer can do. If the banks and the commercials don't want these margin calls, I can't imagine why the American farmer wants them. That's why we'd be using put options, use 08 puts to protect 09 now. If we have a problem, it's going to be now. Use the 08 puts to protect 09 crops.
All right, let's talk about the corn market. You both have brought it up already. As we look ahead for corn, not quite the move this week in corn. And the USDA number in terms of carry, 42 days, not a scary number. What's the outlook for corn? Obviously around $5, Mark. I mean, in my lifetime, that's been a darn good price to sell corn.
It's been a historic price in our lifetime. You know, the price of corn is going to depend, in my opinion, really on one thing. If we have a drought this summer, pick a number on corn. We've seen, you'd be foolish to put a number on it. Could it be $7, $8, $10 if there's a serious drought? If we don't have the drought, with these new seeds that we have out there, some of the yield guard stuff, we're going to see some big yields, and prices can go right back to $3 a bushel here. But I think what's key, again, for the American farmer is to protect it out here and to manage this risk while you have the opportunity. Don't let this slip away from you. Manage the risk today.
All right, Sue, what's your recommendation to a producer on selling? And there's a lot of old crop corn out there, too, which I guess we should mention. But I'm making new crop sales. What would your strategy be for a producer?
Well, I think that when I would look at this market, I've been looking at timing in this market, because we still have an acreage fight that we're going to deal with. I don't think we've fully begun with it. The trade is hearing estimates of maybe only 3 to 4, maybe 5 million acres reduction in corn acres. I think it's going to be much greater than that. I think it's going to be 8 to 9 million acre reduction. And so if that, right now, I think the market's feeling pretty comfortable with the 3 to 5. And so therefore, I don't think you have an acreage fight really feeling its way right now, but I think that's coming. I look at the timing of the market, and I believe that we could have highs as early as April for this market this year. Then from there, we'll take another look, and possibly it could lead us into May, but it's going to take a weather market to carry us on into June and July. Now, we have weather forecasters saying a dry summer, a potential drought. But the key is dry summer with cool weather or dry summer with hot weather. It's a big difference. And so we don't know which one we're looking at. I would say to producers that are looking to start marketing, I think with these high input costs, you do need to lay out some backside coverage here. So I would probably say if you can start to lock in $5 cash corn for new crop, go ahead and start to do a percentage that protects those input costs, and then let the rest of it fly, because if weather hits, we'll probably see beans up, or not beans, but corn up around $6 or $9.
All right, so but again, look, going out, let's go out to next year, 09. Are there some things we should be doing for 09? You mentioned the margin issue. You know, is there an option strategy we should maybe look at for that?
Well, I would say you probably could go ahead and do puts, but you're going to spend a lot of money for those puts. So maybe some put strategies where you buy puts, maybe you buy the $5 puts or the $4.50 puts, maybe go to $4.50 puts, and then sell some further deep out of the money puts to help lower that margin money that you have to put up for those. Because the odds are that you probably won't go back to $3 flat this year on corn. You're into a very volatile, bullish year, and I don't see that volatility settling down much most of the year. I will say this though, Mark. Everything I've looked at in timing says we're going to have a traditional fall this year where prices do decline into October, November.
All right. Mark, same question. Your outlook strategy-wise for a producer on corn?
Well, I agree with Sue. I think the corn acres are going to be much bigger than what we're hearing now. Some of the numbers have been 3 and 4 million. I think they're way off base. I think we're going to see a big switch back into the beans. And I think ultimately we're going to see this acreage war continue. We've been talking about the acreage war for 6 or 8 months. And now the biggest problem has been the wheat. On January 11th, when we had the last wheat report, it said we want to play this game too. So I describe it as musical chairs. We had corn and beans vying for the one chair that was left. All of a sudden the wheat came into the picture as well. Now we had 3 players looking for that one seat. Until we sell this acreage war now, things can change.
Right.
Certainly, if we take another look at the mandates on ethanol now, it doesn't look like that's going to happen. But some of these new studies coming out discussing some of the problems with ethanol and the environmental issues, maybe people start to take a second look at it. The EU is certainly taking a second look at it. That could back us up from needing quite as many corn acres. But all things being equal, we need the acres. The supply and demand numbers say we still have the fight ahead of us. That, again, can launch us to much higher prices in the meantime.
You both are calling for much bigger pullbacks in corn acreage than the industry is.
Exactly.
Now, is part of that input costs, Mark? Is that what you're thinking?
You know, certainly when you see fertilizer going to be pushing $1,000 for anhydrous, you've got to take a look at it. But I think farmers want to get back to a more traditional 50-50 rotation. They got out of it last year, switching into corn. The input costs are incredibly high. They want to go back. And from what we've seen from the seed sales, it's going to be a bigger switch than most people are thinking out there.
All right. Sue, same story?
Well, I agree. The seed sales are indicating that the acreage switch is going to be bigger towards beans. I also think that another reason for the switch is because of the disappointment in the corn yields that we've seen this last year. Even though they were decent, I think there was a little disappointment in the yields as opposed to the beans. So I think that that's probably weighing on this also. But it's a huge thing when you're looking at fertilizer prices where they're at.
All right, let's talk about soybeans. And the other half of this acreage battle, as Mark says, the third. And I'll tell you what, I get a lot of emails from farmers out there who are raising dairy quality hay who are saying, hey, we're trying to buy some acres too with this whole market. And you can also argue cotton with its move this week is saying, hey, I'm part of this whole mix too. Yeah. All right, let's talk about soybeans, Sue. And again, you're thinking we're going to see more soybean acres out there.
That's right, I do. But does that knock the price down substantially just because we've got more acres? No, I don't think so. The one thing we have to remember is, Mark, we have a huge demand base in this world market for the soybean. Furthermore, we dropped, last year, what did we drop? About 13, no, it was even more like 15, 16% in production in the U.S. alone. We dropped in China 5.5%, and we dropped in South America about 11%. And so that was a precursor for this bean market, laid a nice base underneath us. We've got stocks to usage ratios at record low levels. Now, our carryout today dropped around to 160 million bushels, down from 175. I went back and I looked, and in 72, 73, the year of the infamous all-time high 1290 bean market, you had a carryout at that time of 60 million bushels. But the whole key is demand is outstripping production, and therefore our stocks to usage ratio is way low. If you go back and look at years in which you have had a very tight March 1st stocks to usage ratio, not only in the U.S., but in Argentina and Brazil, and we have all 3 this year. We're going to have them March 1st, all 3. In the past, you have had, I think there's been 8 times this has occurred, you have had tremendous rallies in the bean market, especially vented towards the July contract. If you take the average or Olympic mean of that, it would project that your July contracted beans would at least go to around 1561. But we've got so much going on here, and South America, I don't think, is producing really what we did want them to produce. Even if they come up with a decent yield in Brazil, they just didn't plant the acres. And so when I look at the bean market, I think it's a demand market. But underneath all of this is China, the worst winter in history, or 50 years anyway, for central and southern China. And I mean, it's worse than Hurricane Katrina. And you look at that, and they had price controls on food before this even happened. You're going to see tremendous bringing in of pork, beef, beans. That's a big staple in their diets, is beans and bean oil. And so I think demand's going to be very, very good.
All right. Okay, Mark, your take. Sue's very optimistic as far as the soybean thing. What's your take?
You know, again, without a drought, I think the bean prices are incredibly overpriced. When you look at the world carryouts on soybeans, we don't have a soybean shortage around the world. Yes, things are tight here in the U.S. We know the Brazilians, or our office in Brazil tells us that they're going to plant 5 or 6% more acres of beans this year. When we look at the demand that's here, mainly the Chinese, every time we've had one of these bull markets in the beans, every spike, within 6 to 8 weeks, you were back down toward the historical prices. Now, I'm not suggesting sometime in the next 6 weeks, excuse me, we're going back down, but I am suggesting that we're going to overproduce again at some point. Demand's going to back off, and we're going to have a serious problem in this bean market without a drought. Now, can we go higher? Is this acreage war and still battle through March until we get the final numbers March 31st, or maybe even March 17th when we get the final insurance numbers in? Possibly. But ultimately, without the drought, bean prices, in my opinion, are way too high. I don't know where prices are going. I don't know if we're going to see $22 beans or $32 beans or $5 beans. But I do know you can buy an $11 put today for 50 cents. Yes, they're expensive, but look at what it's protecting. It's protecting $6 to the downside. Let's see where the upside goes and protect the downside and manage the risk.
All right, so that's your strategy. Same question for next year, because we've always talked to people about, you know, marketing through these bull markets, getting 2 years crop in the books.
You know, in 09, the biggest problem with going out and looking at 09 and 10 sales, what are your input costs going to be? If you can tell me what your input costs are, or if you're going to tell me I own the land outright and you're not that concerned about it, fine, go ahead and make some sales out there. But if the input costs are going to be an issue, what's going to be cash rent? What's going to be fertilizer prices? You know, if Sue's right and, you know, $5 wheat winds up being cheap historically, do you want to be selling $5 beans that could be, or $5 corn that could be $10 corn 2 years from now? Probably not. So again, I would use the 08 options to protect 09 crops. Let's see what 010 brings. Take it one step at a time.
So you go along with that?
Well, I guess I tend to, you know, I'm pretty optimistic, so I'm having a little struggle here. But I think that we look at a bean market, and again, I go back to timing on the beans. And in years that I look at timing for this type of a year, we would have at least an April high, never a February high. And when you look at taking out these all-time highs like beans have done here this week, we have done it by a mere 6.5% maybe, where if you look at the previous highs taken out in corn and wheat, corn did in 1996 exceeded their highs by 38%, wheat's done it by 14%. I think that the beans are not nowhere close to being done.
All right, let's talk about the flip side of all this. Half the commodities we produce, corn and soybeans, are fed to livestock. And these livestock guys have been under pressure. Mark, you've seen it. We've seen it on the board. Fed cattle market, there's a lot of concern down the road about consumers paying $3 a gallon for gas, how much beef are they going to buy, and so forth. Prices are higher in stores. We've heard from on the pork side of liquidations. What do you see ahead livestock-wise? What do you see?
Well, when in 1996, when we had $5.50 corn, we had $55 fat cattle and about $47 feeders. I'm very concerned about this cattle market. Historically, we are at very high prices, and again, I'd be wanting to protect that downside in case this thing falls apart. Now, I'm not suggesting we're going back to $55 fat cattle, but at that time, we was about a $30 break off the highs. So if you take a $30 break off of these highs, can we go back to the low 80s, maybe the high 70s? I don't think that's unreasonable. We've seen fairly robust demand for our beef out there. Certainly the export market has been good on the beef. As far as the pork goes, we're killing sows, and the Canadians are killing sows to beat the band. We've got this $15 discrepancy between the nearby hogs and the back months, that can get even wider. For the next 18 months or so, or not 18 months, let's say 12 months, I could see these hog prices getting excited. And if we start exceeding some of those old highs, pick a number on the hogs if we're starting to run out of these hogs and if the Chinese want to buy some pork. So I'm a little bit bearish on the cattle. I'm very friendly on the hogs. We'll see where we can go long term.
All right. Sue, same question. Fed cattle, what do you see?
Well, I think with the fats, I tend to be a little bit negative towards the April time frame. I think that as we go through the March and April period, we're going to see a fair amount of formulated contracts of cattle, and I think therefore the packer won't have to be aggressive in bidding for cattle. So I think if you get the April futures up around 96.50 to 97 cents, I would be hedging those cattle. I look at the feeder market, and I think that the feeder market going into April and May also is probably going to be under fire a little bit. Once we get in towards the latter part of summer, you know, I think that the cattle market's going to be pretty good through the fourth quarter of this year. I think that our numbers are going to be down substantially towards the fourth quarter. You get past February, and I don't think you're going to see the placements like we've been seeing. And so I look at the cattle market, and I tend to be bearish up front, very friendly to the deferreds. Now, the economy might have something to do with that, too. Because as people aren't making very much or losing, and I call the people as like our senior citizens or the people that are retired, you know, they rely on the stock market pretty good for returns, and that's not helping them right now. So it might cut back on their going out to eat a little bit. All
right. Well, what about on the hogs? And you mentioned potential export demand, some other issues out there. Near term, some trouble, but longer term, some good opportunities.
Well, I look at the hog market, and we had some issues last year in the latter third of the year with conception, breeding, that type of thing. And so those numbers, it would indicate that we're going to have a tighter supply of hogs as we go into the more of the June, July, August timeframe. Along with it, demand for pork ought to be phenomenal on the export side of things, and it's also a cheaper meat. So I think demand's good. So I would have to agree with Mark. I think we're going to see a better hog market, and near term, probably good as well.
All righty. Well, I appreciate both your insights, Sue Martin and Mark Gold. Thank you so much. That'll wrap up this edition of Market to Market, our special market edition. Now, if you'd like more information from Sue and Mark on these historic markets and risk management strategies, visit the Market Plus page at our website, where you'll find streaming video of our program. And you can also download audio podcasts of our market analysis and Market Plus segments absolutely free at our website. And be sure to join us again next week when we'll examine a controversial report on global ethanol production. Until then, thanks for watching. I'm Mark Pearson. Have a great week.